Thank you, and thank you to the entire team. In fact, at Equalify, I think what you guys are trying to do is something that we really think is a fantastic initiative, and that's why we were so keen to partner with this. Uh, um, and I'll talk about my views and how I see the entire PMS AIF, or what we call the alternative industry, evolving. But first and foremost, for any sort of new industry to take shape, is that you need a lot of people with the required skill set, with the required understanding, and I think that is that's why it's so wonderful that we have forums like these, which allow a large number of people to participate and sort of share ideas, understanding, etc. See what's going on, and really wonderful initiative. With that, let me kickstart my thoughts. What I'll do in sort of the 20-25 odd minutes that I have got is lay out a context in terms of what I believe uh, we are seeing in terms of the growth and the evolution of the AIF PMS industry. And I'll try and see it from a few different dimensions. What are the key drivers that are enabling it? What are some of the developments that we are seeing as we, especially in the more recent years, which are really giving it a big leg up. But to kickstart this, just in terms of the context, I think one of the big successes in the last 20-25 years we've seen is just the way the mutual fund industry has grown and become more and more relevant in the financial savings pie of the general population in India. I'm sure you all know the big numbers, but the staggering thing is that the industry, which is give or take somewhere in the region of about 36 lakh crores today, if you go back 10 years, was maybe one fifth that size, closer to 7 odd lakh crores back then. And we've seen the industry grow at almost close to 15 to 20% kind of compounded annual growth rates over this period. Um, I believe a lot of that growth was set in stage because of the good work that mutual funds did in the first decade of this century, which is basically 2000 2010, where a lot of the performance, the products, the skill set was put in place, which gave investors the comfort and the confidence to start allocating material money and to benefit from this. And as it became a sort of a virtuous cycle where good products, good performance, good experience of investors allowed more and more investors and newer investors to get drawn in, and that's what's worked for that industry. The coincidence is that if you look back, if you draw that parallel with what we call the alternatives industry, the AIF PMS, we are at about, and if I draw the sort of somewhere the birth of this alternative industry, and I know in some form or shape it's been around for a very long time, but I think really the fillip got going with the AIF regulations, which SEBI put in place roughly about 10 years ago. So from an industry perspective, I think we have now spent a decade sort of just putting together the platform, what this stands for, getting the first phase of the platform really in place. And coincidentally, we are at a size where the mutual fund industry was about 10 years ago, while in terms of, if you add the AIF PMS numbers, we're roughly, give or take, in the region of about 7.5 lakh crores in AUM. Of course, our growth rates are much higher, given that we're starting off a smaller base. So this industry is now growing at more like a 25 to 30% growth rate. Mutual fund is a much bigger industry, growing at 15 to 20. But I think the power of this idea is now very well established, and it's really now very much ready to really go for the next leg of growth over the next 10 years. And which is why I think, and I mentioned this in my run up and my remarks to this event, that the excitement that I feel in terms of the point in time that we are right now in the alternatives industries, I think that this is the most important development, or the most important thing that has happened in any investment industry in India in the last 20 years. Because if you go back to mutual funds 20 years ago and this one today, that's really the power that this can bring in in terms of the change that it can bring to the landscape of investments in India for investors. Um, why are we so confident? Like I said, there are a number of different dimensions that are driving this, and let me take some of them, one by one. The first and foremost, I think what we are seeing, and many, by the way, of these trends are not limited to India. We are seeing these trends play globally, and India is also joining that. So one of the big trends is that there is a little bit of a barbell that we are seeing in terms of the investors' attitude towards risk, towards complexity, towards sophistication, and they are actually approaching this at increasingly in two different extremes. On the one hand, we are seeing increasing favor and bias for very simple, very liquid products, and what we have seen is the boom in the passive space, index funds and ETFs as one extreme outcome of that. Very simple, easy to understand, easy to execute strategies, highly liquid, uh, give people the power to really be on top of that in a very simple and easy way. But on the other hand of the spectrum, we are seeing demand for highly sophisticated, highly complex, different risk payoffs which investors want. So there is this dichotomy which is happening, and as I said, this is not unique to India. This is happening at a global level where investors want and increasingly are gravitating towards these two extremes where part of the portfolio is very simple and easy and straightforward like passives, and a part of the portfolio is into very complex and more sophisticated strategies represented by, broadly speaking, the alternative industry. Why is this happening? The need for this is essentially the need for, at a portfolio level, people have understood the need for diversification, the need for having different asset classes and lack of correlation between different asset classes to come in. And increasingly, the simplicity allows you to capture the beta of the market, whether it's the debt markets or the equity markets, in a very simple, cost efficient, transparent manner. But there is also other risk profiles and other return profiles to be made, which the sophisticated strategies allow you to capture. So can you invest into hard assets? Can you invest into different payoff profiles? Can you invest into different risk management approaches? And that's what alternatives allow you to do. In many ways, this is also represented by what the regulatory environment is doing, where what we have seen is increasingly the mutual funds getting more and more straitjacketed in terms of their profiles, in terms of what their investment objectives are, in terms of what their strategies can be, so that the investors are getting more and more sort of are able to enjoy investing in them in a very simple and easy and transparent manner. And on the other hand, the what is represented by, let's say, the AIF regulations, which allow you to try for the sophisticated sectors. So that's the first context, which is the investor context, which is that there is a need for these two extremes, and people understand intuitively what they bring to the table. That this is also, I think, coming out of the better understanding and informed nature of the investor community itself that we have seen. I think, again, I will draw this parallel with the growth in the mutual fund industry, where we have seen a huge jump in number of investors and their participation. And somewhere that awareness, education, understanding is now flowing through in the form of people being able to better appreciate some of these newer opportunities. It's also in the last 2, 3, 4 years, I would say it's also really a great context from a regulatory environment where a number of different things are now also in place for the next leg. I mentioned that the first leg of the alternatives, I think the trigger was the AIF regulations, which really put in place the context framework for offering some of these strategies. And I think last 2, 3 years, we've seen some really significant new ideas that have come in here. And if I were to name 2 or 3, I think we've seen a dramatic overhaul of the PMS regulations. We have seen provisions for accredited investors. We've seen provisions around how co-investments can be made. Slightly on a different note, but we've also seen the emergence of Gift City and structuring options for global investors coming in as well. So there is a bunch of exciting developments that are taking place in terms of the regulatory architecture, and also I suspect reflecting the maturity of the AIF as a platform that we are able to take advantage of as an industry. Um, the other thing that we are seeing also is the broadening of the players. When you say players, you can see it from both sides. One is from the manufacturing or the investment side, and the other one is from the investor or the investor community side. Let me take the manufacturing side first. Historically, alternative investments were done much more out of the big global investors and who used to raise global pools of capital and invest into India. We've seen the big famous private equity funds, the big famous real estate funds, and the examples are there, hedge funds, etc. Big global giants who used to also invest into India. What is changing now is the emergence of very strong domestic players, which are both some in some cases boutique managers, which are run by the investors themselves, and that's a very healthy profile because these boutiques are typically founded by the key fund managers or investors who understand what they're getting into, and they want really the firms to reflect that. And on the other extreme, by large financial platforms such as for example us here at Access, but a number of other domestic platforms are also come up where they are able to solve for using a much better understanding of the domestic market, what is the right set of invest offerings, as well as how to engage with the investors in the right way. So there is a big diversification happening, like I said, in terms of the the investment manager or the manufacturing end, where from a more global led, we are seeing a more domestic led, within domestic boutiques and large domestic platforms. On the investor side, again, we are seeing much more broadening. We are seeing a situation where we are going from, again, more driven by dominated by global uh, institutional investor base to, again, a much more solid local investor base, both including HNIs, including family offices, including domestic institutions. So effectively, this is becoming local for local is a word that I think it used to be global for global fund managers solving for global investors, and just happen to invest into India along with other markets. That has implications in terms of product development, in terms of innovation, in terms of what happens when global cycles change, and how that has unintended consequences for India. But when you have a large local for local market, local investors raising local money for investing in the local market, and that is where we really see a huge sea change, because we are now solving for local issues, solving for local investor requirements, and that is where the whole industry is now flipped, and that's really giving the fillip to the next leg of growth. The next thing is just the broadening of the product and the asset classes that we are seeing. So alternative investments, we all know, it's Cat 1, Cat 2, Cat 3 on the AIF, PMS, all sort of, it's a broad spectrum. Just a quick recap for everyone's benefit. Cat 1 typically is where you have angel, venture, you can have infra, you can have a few socially relevant schemes, etc. Cat 2 is typically where your growth, private equity, real estate, private credit kind of strategies. Cat 3 is typically your listed leverage, hedge fund, or long only kind of listed strategies come in. PMS, of course, is segregated accounts. But within that broad framework, what we've also seen is a huge broadening of strategies that have been on offer. And that is linked to the first 2 points. I think I made the first point, which is about the investor barbell, seeking complex strategies, seeking different payoff structures. The second one was the broadening of the mix between what type of manufacturers and what type of investors there are, and both of them have a direct implications on innovation and the kind of strategies that are done. Today we are in a midst of a unprecedented breadth of offerings within the alternatives platform. You have a bunch of different credit strategies, a bunch of different equity strategies, bunch of different real asset strategies, and each of them I can talk about more. Within credit, you have structured credit performing, you could have special situations or distressed. You could, within equity, you could have starting from the entire life cycle of the company, starting from angel to venture to growth to buyout to special situations. For all the entire stage of the cycle of the company, you have different pools of capital available. You have hard assets, whether it's real estate, infrastructure. Again, within them, whichever type of risk profile, both equity and debt, which is available to investors. We have commodities, of course, alongside within the hard assets. So literally is a plethora of avenues that have opened up, and this innovation which has happened to answer the environment requirement of investors. I will also talk about how we have approached it here in this context, just to draw a parallel within Access. Um, what we've recognized is that this space, it is not a product push space. It's not about coming with one fantastic fund and going and sort of seeking finding investors for that one product, because the mindset that is required here is more of a solutions mindset. What you need is to understand the pain points, understand the risk return trade-offs that investors are looking for, and how you can solve for those things through your products. And what that invariably means is that for the manufacturers, you have to be able to approach it as a platform and not as one product offering or one or two or X number of different product offerings. What we have done, for example, at Access is that our platform today has a number of different offerings. And if I were to name them, we have real estate, both commercial and residential. We have late stage private equity. We have private credit, it's what we call structured credit. We're just getting into special situations or special opportunities. Within the listed framework, we have quantitative and thematic equity offerings. So if you look at it already, then there is a bunch of different offerings with very, very different payoff structures. And what that does is that it allows us to engage with different investors. And we talked about the different type of investors. Institutions have very different wants. Different institutions have different wants. A family office can have very different wants. So allows us to engage and solve for the different asks for different investors and really work out whatever works best for them. What it also does when you have a platform is also allows you to engage for a number of different partnerships. That's something, again, that we at Access have done in a very proactive manner, where we've done a number of different partnerships to be able to offer different ideas to the investors, and also be open to structuring ideas and doing structures where you can do certain amount of customizations and structuring through the right vehicles which may be available for investor needs. So that's something that as manufacturers, increasingly each and every one of us will have to be open to do, and it's a very vibrant space that we're going to get into, which will see a lot of innovation. With that context, let me spend a few minutes in terms of how to investors approach this space. And Aditya mentioned it, and I think there is today for people, there could be a sense that there is a little bit of is there too much choice, or is there an element of there being confusion, because just so many things approaching you from so many different sides. So as investors, how do we make sure, or as partners, as distribution partners, how do we make sure that we understand what the objectives are for each of these offerings, and how do we make sure that we get into the right one? I would say 3-4 things that can be done to help navigate this space in the right way for investors. First and foremost, I think the investors need to understand why they are looking for alternative ideas. I mentioned risk return payoff. Let me give a couple of examples. You could capture the beta in market today very easily, right? So for equity products, it's easy enough. Listed equity, capture the beta through a set of passive options which are there. However, what they will not give you is access to, let's say companies that are innovating or in the private market and who are able to potentially grow at a much faster pace. So one use case is that as investor, you understand the power of equity growth capital over long terms, but you want to broaden your equity spectrum from a pure play sort of listed equity to something that goes beyond that into the unlisted side, and therefore that is the with that you try and solve for which offerings can help you achieve that. A very separate, different second kind of a discussion could be that you're looking for maybe as an investor, you have a certain equity cash flows, equity sort of allocations again through listed market, but you're looking for something that can complement that and give you some very reasonable IRRs, but also regular cash flows and also some lack of correlation with equity markets. Therefore, can there be something like a structured credit offering which could help you achieve that by complementing your equity ones? Still gives you reasonable IRRs, but unlike equity, which requires a much longer commitment, can give you some regularity of cash flows to play with. So these are just a couple of very, very simplistic use cases that I've thrown in. But the idea behind saying this is that as investors, first and foremost, we have to really understand what is it that our objectives are and how different products can or different offerings can help us solve for that. The second thing is to also spend a lot of time and effort to just educate ourselves, and that's I goes back to the where I started, which is, I think it's a brilliant thing by Qualify to get all of us together into this kind of a platform. And I think this area will require, there is no real shortcut. It will require time and effort to be invested by people to really understand the offerings, understand implications of the different offerings. And that is again something that they can really, they will really have to do. Once you have in a certain sense, having that education allows you to also better appreciate what may work for the portfolio, what may not work. Because right now, one of the things that we do come across when we talk to investors is that there are certain big sort of rule of thumbs that people make. Okay, how much lock-in is there, or what is the target IRR of the product, and sort of 2-3 big headline numbers uh, can very quickly people sort of use to decide whether or not this product works for them. And I think that can be quite a sort of a self-defeating thing, because yes, you need to know the lock-in. Yes, you should have a handle on the target IRR, but the more important thing is to understand the strategy itself. Where is the money getting invested? What is the asset class? What is the risk that you're taking in? And how is that talking to the rest of your portfolio? And there's nothing to be scared about lock-in, right? If you have a portfolio where out of 100 rupees, let's say 90% of it is into very, very liquid investments, which are available to you on a daily liquidity basis. It allows you a lot of elbow room for that 10 rupees to then get allocated to slightly liquid assets, provided, of course, that the risk return of those asset classes are complementing that core book and is meeting your objectives. So I think too much focus is on lock-in, too much focus on target IRRs, too much focus on the flavor of the month rather than trying to understand the context of the investor's portfolio. And that is what I would really, that's my last point, that there is no substitute for education. There is no substitute for spending the time and effort to really understand these products and spend understanding these asset classes, and really then make sure that you find the right ones without really trying to get too bogged down with one or two variables within these products. So with that, like I said, this is, I believe over the next 10 years, we will see the golden age of alternative investments in India. This is the time for local. This is the time where you'll see the emergence of the big local giants within alternative space in terms of investment houses. You will also see much more increasing sophistication on the part of investors who are going to be able to find much better ways of using these strategies into their portfolios. So I think it's a great time, very, very exciting times for all of us. And for us as Access, for example, we have really said that this is going to be a big driver for within our business strategy over the next 5 years, 10 years. And alternative is going to play a very, very big role within that. So just reflective of what opportunities we are seeing firsthand here at Access as well. So with that, I'll pause here and give it back to you, Aditya. And thanks again a lot for eQualify team to put this together and giving us this platform and this opportunity. Really looking forward to a very good set of sessions today as well as the rest of the program.